Welcome to the final part of this margin trading series where we're going to be selling a naked call in our demo simulated account on Interactive Brokers. And if you are brand new, I strongly encourage you to check out part 1 and part 2, where in the first part we go through all the definitions of everything to do with margin, around margin maintenance, initial margin, excess liquidity, buying power, all of those different pieces. And then in the second part, we sold a naked put on Square, and we looked at really how much margin we needed to place the trade, but what happened to all of our numbers after we placed that trade. And in this final part, again, we'll be selling a naked call on a different underlying, just so you can see what happens to these numbers. So again, check those videos out. They are in the description. I'll try, if you don't want to watch those or don't have time to watch those, I'll try to refer back as best as I can to make this relevant to anyone that is watching. We have a quick look at the numbers before we open the naked call. Firstly, on the Square position, it's only been about 20-30 minutes since I placed the position from when I did that video. So you can see that the position is down slightly by $11.68. And if the position starts going against us, our maintenance margin, which is the margin needed to hold the position, will start to increase. And I think from the back end of the previous video, it was around 760, 770. And you can see that number has jumped up slightly. And that number will continue to jump up as the trade starts to go against us. But what you've also got to remember is this margin maintenance affects our excess liquidity. And I'll keep saying this, excess liquidity is probably the most important number when trading on margin. If this number, which currently stands at 5.6K, drops to 0, then you will be margin called and trades that you have open will start to be liquidated. So what we want to do is make sure that we place trades that do not impact our excess liquidity by that much, so that if positions go against us, we still have margin available to help us get out of these particular positions. And what I wanted to do in this call or naked call option is go for a more expensive stock to show you that you can still place the trade, but what happens to your excess liquidity after you place the trade, and how you could be trading quite big for your account size. So I'm going to show you the benefits of trading on margin, where you can trade higher, more expensive underlyings to generate more premium, but at the same time, how does that impact the margin that you have available to continue trading? So what we're going to do for this example, we're going to go into Google. Now, Google is a $105 stock. And like I mentioned before in the previous video, if you want to sell a put on this, it would be just over $10,000 to place this trade. Now, because we're selling a naked call, unlike a covered call where you have 100 shares already as collateral, you'll basically have no collateral in terms of 100 shares. So you have unlimited risk to the upside if Google continues past your strike price. So different brokers will define the margin requirements very differently, and we can calculate that for Google so we can see before we place the trade, do we want to be placing this particular trade? So if we go into options, and again, I talked about in the last video that I like to sell options on the weekly cycle, 45 to 60 days out, and the first monthly cycle that fits that criteria is June the 16th. Now, because we are looking at calls, we want to look at the left-hand side, and obviously the strikes are going up. And I'm going to do something, and again, let's just say we're quite happy for Google to do a 20% move. So it's trading, let's say it's trading at 106 times by 1.2. That's $127.20. So we've got the $127 strike. And if we look to sell that, you can see we'll get somewhere around $37. Now, on a cash secured, if you've got 100 shares and your cost basis is below $127, you're generating some premium to reduce your cost basis on Google. So if we, again, as I mentioned before, I like to just do market for demo accounts or simulated accounts because limit prices take a bit longer to get filled. But what we'll do, we'll hit preview as we did in the previous video. And what this will do, it'll tell us what happens if we were to place this particular trade. So you can see here that we're making around $37 plus commissions. We're making around $35.91 if we were to get filled at this price. Equity to loan, which is the total cash plus your stock portfolio. So in our case, it is just our cash because we don't hold any stock in this portfolio. So it currently stands at $6,420. We're going to be generating $35 of premium or credit. And as with selling options, money gets deposited straight into your account and you can use it as cash. So therefore, equities loan jumps up by $35 to $6,456. Initial margin is the margin needed to place a trade. So you can see here, we currently have an initial margin of $2,165, and that is for opening the square position. And now you can see here that we would need an additional $1,963 to open the Google position, taking our total initial margin to $4,129. Now, initial margin is part of your buying power. Again, I've got into it in the last two videos, but effectively our buying power will go down because we're opening a new position. And again, go back to check out the other videos to work out by how much it goes down by. And then last one here, you got maintenance margin. This is the margin required to hold a particular position. Currently it's 814 to hold the square position, and that will go up to 1,432 to hold the Google position. Now that kind of makes sense because Google is a $100+ stock. Square is around the $60 stock. So you got the strike price you select, the current price of the underlying, as well as the volatility of that underlying. All those factors are taken into account in IBKR, or your broker will calculate that you need around $1,400 of margin. So that is around, if we take the strike price, 1432 of 127.5, it's about 11-ish% that you need to place this, which again is pretty good in terms of trading on a small account with 6K of cash on there. So we can see here that post-trade, we go up to 2,246. So now we can calculate what our return on investment would be on this particular trade. And I always like to use the bigger number of the two, which in this case is the initial margin. So it'd be $35 in credit divided by $1,963. You can see here, we are making 1.7% return on our capital that is used. Now, the question you've got to ask yourself is, can that 1.9K be used elsewhere to generate a better return? For me personally, this is not a very good trade. A, because the account size is too small, and B, you're only making 1.7% return on capital on trade entry. So it's not the best trade, but again, this is for illustration and demonstration purposes only. And the last thing I want to talk about is, again, excess liquidity. IBKR do not show the excess liquidity in this screen, which they really should do. But we know, if we go back to the previous videos, excess liquidity is equity to loan minus maintenance margin. So our current excess liquidity is 5.6K. So if we take 6,456 minus 2,246, our X liquidity should drop to around 4.2K, which again makes sense that it will drop because we're opening a new position. So let's hopefully see if we can get filled on this trade pretty quickly. So again, we are selling the 127 call, which is about a 20% move from the current price where it is Google needs to move, which is a big move for Google, which is why the premium is quite low. And I would imagine why the margin required is also quite low in the grand scheme of things. So if we slide to submit this order, we are pending. Okay, we've just got filled on there, which is good. If we go back to the portfolio, you will see here that we now have the Google call, and our excess liquidity, as I mentioned, dropped to 4.2K. As I said before, if this number drops to 0, you'll start being margin called and positions will start being closed down automatically by IBKR. So it's important that you keep an eye on your excess liquidity just to make sure you are being compliant, as well as if you need to put more money in or decide to close down any open positions that are in profit to release some margin, that is what we need to do. Your margin maintenance has gone up as expected. Your buying power dropped from 17K to 9K. to place this position. So again, you can see here how this works in terms of everything that's happening, and our cash has gone up from 6.42 to 6.46 because we have generated that $37 in credit. So I really hope this makes sense to you on the numbers you need to understand for trading for a margin account. Again, these are not the trades that I would be looking to place. The square position might be, because again, there's still a lot in there, but you can see how you can trade a $127 stock with only 6K of cash. But at the same time, you can see how you can over leverage yourself by doing 2 contracts, 3 contracts, all these other different things. So my key kind of takeaway tips would be is making sure that you don't trade more than 1 contract, because that's the smallest you can trade. So if you're just getting started, don't trade more than 1 contract. You also want to make sure that no trade is taking more than 2 to 3% of your overall margin maintenance, and that will put you in a good position in relation to your overall cash that you have inside your account with a good enough buffer. So again, keep in mind of your buying power as well, because again, the more trades you open, with more contract sizes, the lower that will be, and therefore you can't open any new positions. And again, I really hope you found this useful. Again, comment, subscribe, like down below if you want to see more trades on margin, how this impacts your portfolio. If you've got any questions, please reach out, and I hope you've enjoyed this mini 3-part series.